Hey traders, welcome to Charts and Coffee. Hope everyone is having a good morning. We are taking a look at the last trading day of 2024. I treat this as a half day. And let me get into why you'll hear me refer to today as a half trading day. We have an interesting schedule over the next week or so because tomorrow, obviously, we're closed. It's New Year's Day. Thursday, Friday, oftentimes after New Year's, we'll end up with the first Friday of the new month. And that's usually non-farm payroll, but not this year. Non-farm is not until next week. So non-farm is going to be the week of the 6th. And then also the week of the 6th, we have a bank holiday as the markets are closed for President Carter's funeral. And so we have a very interesting beginning of the week where next Friday we have NFP, but next Thursday the markets are closed and tomorrow the markets are closed. So a lot of starts and stops. So the question is, when do we get back to regular sort of regular trading action? And the best way to gauge that would be volume and events. So if we're talking about volume, we're talking about what is a typical volume that we would see on average, and are we at or exceeding that level once we're, say, halfway through the session? And the other one will be events. Obviously next Friday, not this Friday, next week. That's actually going to be in fact, let's jump on over to the calendar here. So if we jump on over to, we could use, say, the Forex Factory calendar and jump on over here. First, markets are closed, bank holidays around the world. Thursday, we have our typical unemployment claims. Crude oil inventories, by the way, is pushed out to Thursday the 2nd, as if anyone's paying really any attention to that. And then we go into Friday. Now we get our first somewhat interesting bit of data on Friday with the ISM manufacturing PMI, which we consider a little bit more of an inflation-related type metric. And then we have FOMC member Barkin on Friday the 3rd. But again, probably not a lot of reason to really come back as far as, are these compelling reasons as far as macroeconomic rate of change data to come back? And I'd say for the most part, no. January 10, you'll see that's where we get our non-farm. And this is probably going to be the most important release between now and January 29, because on that day, we get the big jobs number. The Federal Reserve has a dual mandate. Here we go. The Federal Reserve has a dual mandate in terms of hit the inflation target, but don't destroy the jobs narrative between now and then. And you'll see the 29th, we're still very much sitting at a hold. So even though we cut half a percent in September, another quarter in November, another quarter in December, there's no meeting in October. The first meeting of the new year is the 29th of January. The second meeting of the new year is 19th of March. And it looks like we might hold. Now, a lot could change between now and the 29th of January. One of the most meaningful data releases we'll get will be that non-farm, the second Friday of January. So we keep an eye on all these things. When would attention come back? When will we start figuring out whether we're going to hold or cut in January? What's interesting, though, is if you go out through the remainder of the year, there is at least one more, if not two more quarter point cuts baked in. There is expectation, not massive expectation, but as you can see here, by the time we get to March, it's a 50-50 coin toss as to whether or not we cut or hold. But by the time we're out in May, when we get out at the beginning of summer, there is at least one, if not two more rate cuts, but definitely one a little bit more priced in than not. And the reason May doesn't have this tall 100% cut is because up through May, there's still this small percentage. We might get another quarter point cut. And then this 47% would show we get a quarter point cut in May, as opposed to 16.7% that we already got one, and into May we would get another, right? But there's still 34% that we could hold clear out into May. So This is where we sit. And if you're wondering why equities are kind of throwing a little bit of a fit, where are those consistent all-time highs? You'll see that some of the heaviness that we're seeing going into year's end is going to be uncertainty. We do have a new administration coming in. What are the economic policies that are going to benefit, stocks? We know that there is a very different tone. Jerome Powell took a very different tone at the mid-month FOMC meeting. It certainly has affected S&P and Dow names more than, say, tech. Tech's hanging in there. It's not the trend that it was through most of December, but it's still neutral to bullish. And that's a really important point to make as you're going into the new year. Please don't look at equities as just binary, bullish or bearish. It doesn't have to be just that, right? Anyone who's been out on the water, my folks out there who say sail, wind does not just move due north, just like the markets don't move due south or due north. There's going to be a little bit of an influence at an angle. Well, what's the angle here? It's up, right? So even though we're a little bit neutral right now, there's no reason to presume that we won't continue in that direction, maybe not with the same vigor that we were earlier when the expectation was for a more accommodative Federal Reserve. How we got maybe the bulk of the cuts, that seems to be it. Now, if the equity markets want to rally, they're going to have to do it on reasons other than cheap money. And that's where we sit at this point in time. All right, what am I typically doing this time of year? So there's two things that I will do this time of year. Number one is I slow down my trades. In fact, my Sector Secrets Mastery folks, we've been doing a little bit more of a recap type view of the type of trades we put on, what went well, what could we have done better, and we'll think about what kind of macro, what kind of trends we're taking into 2025. Not nearly the strength that we saw in Q1 or even Q3 and 4 of 2024. The macro narrative has, for the most part, played out. The best part of any rate adjusting trade, in other words, before we get the rate hike or cut, the anticipation of is sometimes the best price action. Once we start getting the thing, it's not necessarily the follow through with anticipating the thing, right? In other words, it's the getting, not the having. And once we get the rate cut, in this case, we had that 50 basis point in September. From there, it's been a little bit of a letdown. It's been a little bit of deflating, even though we've hit consistently higher highs as we wrap up the year. Next year is going to have to stand on something other than lower rates. We'll have the low rates. So the next question is, well, how long? Will we cut and hold? Or is it this sort of odd expectation that Jerome Powell and company have cut, and then now they're going to go about setting the expectations for the eventual hikes? It shouldn't be that quick. In fact, we should see low rates based on Fed fund futures. I'm not talking my opinion. These aren't my feelings, right? This is not what I'm thinking. This is what I'm seeing. And what the data says for now is that we're going to cut and likely hold. And that's better than cut and start to sound hawkish. But eventually, the Federal Reserve will start to sound hawkish, as they often sound dovish, favoring rate cuts, right? Hawkish, favoring rate hikes. They'll sound that way. They'll talk it up before they actually do the thing. So the talking precedes the actual doing. Same thing this year. It's the talking that will be usually the best time to put on trades with the anticipation of whatever that monetary policy shift is. All right. So what's a trader to do now? What's an investor to do now? Well, patience. I think one of the biggest mistakes traders make when they get into trading is thinking like an employee. Many of us were, on the clock at some point. And so for here, we must be doing something. Trading is a employment is a time-based economy, a time-based reality. Trading is results-based. Nobody is going to get extra brownie points for being here at 4 a.m. and preparing. The market doesn't care. The market just knows, did you buy low, sell high? Did you sell high, buy low? Was it a good trade or was it not? And that's where less is more. That's where being flat is a position, and being comfortable doing nothing, and even more so, being comfortable doing nothing when it seems like other people are winning, are doing well, making big decisions. I'm going to say it flatly. There is the real world, and then there's social media. and there's television, and there's financial Twitter. Those folks, let's just admit it, they never lose. They never lose. They always knew today was going to be a down day, or today was going to be an up day. They're always in cash at the perfect point. They're, spare me, right? I need my hip boots if I'm going to continue on this line of thought. So just remember, shut that out, because I'll tell you right now, the best traders I know don't talk much unless they've chosen to teach, in which case, well, then, yeah, we're going to talk. We're going to tell people what we do. But for the most part, the best traders out there will be folks you've never heard of. And that's exactly the way they like it. So keep in mind, just because it was a down day, and if you had long positions or if you weren't short or whatever, remember your time frame, your setup, your time horizon, your position sizing, your risk management may not be the same as whatever person is on financial media, social media, you name it, Insta, TikTok, where do all the geniuses live? Twitter, right? If your trade does not sound like whatever they're bragging about, believe me, it's okay. As long as you are following your plan and your goal and your time horizon, etc. The part of that so few people want to talk about is, when folks do, hit for the fences, they want to knock one over the wall. They're looking for that home run, that grand slam. The flip side of that is often a lot of strikeouts. And nobody wants to talk about those. Nobody steps up to plate and hits a home run every time. The trick is, are you getting on base? And that's a completely different mindset. I don't care if I hit a home run every month or every week. I don't need to, right? I just need to get on base, right? I need to bat runs in. I just want to make sure I'm healthy for every game. So that's why I say I like the Cal Ripken school of trading. I know I'm dating myself, but that was one of my favorite ball players growing up. He was healthy for every game. He was a great teammate. He got on base. He drove runs in. That's the kind of trader that, yeah, they're not going to write a movie about you. And there's not going to be a big book and whatever other braggadocious thing they show. But that's what trading is. Just the grind, little wins. And sometimes those little wins are big wins. We had some we had some small wins that turned into giant wins with, say, Amazon. Right? We had 2-3 positions long in Amazon over the past 3 to 4 weeks. And this was not on my bingo card for one of my bigger trades in the last quarter. And yet we did what? We thought about position size. We thought about risk management. We let the trade do the heavy lifting. The notion that I can ultimately dictate where a trade is carried to, that's not in my hands. We know this, right? So when we have a really big up day and someone's bragging about it, like, what did you do? The market went up and you were long. Acknowledge you did a good job getting along, and then acknowledge that the rest of it was the market's doing. Those are things real traders do, right? We acknowledge the market is, whatever that price action is a big part of the responsibility of why we won or lost on a given day. Our job is to manage risk. You take a look at what's going on with Bitcoin. One of our preferred ways, and shout out to the bot who's been trading things like MBT and BTC in the, here we go. Take a peek. Look at that support. She's been looking at this in the Sector Secrets master room. And ultimately, if I look at Bitcoin, when did the frenzy get really frothy? Obviously, as we got to and through 100,000. But please know it's been moving higher for a good bit. Ultimately, this is where the trading gets tough again, because a lot of retail traders buy into higher highs. And when you have a frenzied move like we did basically end of October into December, any all higher high pretty much at some point is going to give that person an exit. But is that really the way we want to trade? No, the way we want to trade is thinking about when we pull back, when will that pullback be something we don't want to hang on to anymore as a trade? And what's an affordable way to get into something like Bitcoin? Maybe it's micro, maybe it's something like IBIT. And this is something that bot said, hey, you know what? The best way to trade Bitcoin right now is IBIT. And so that's where we've been focusing on options, call options, to take advantage of maybe a resumption of the trend, or acknowledging that maybe the best part of this narrative is in the rear view mirror, right? These are all things to keep in mind. So, ultimately, what I want to point out is this is not the same Bitcoin market that it was in the immediacy after the election. Could it resume? Yes, but let's acknowledge that it's gotten a little wobbly, but we know how we want to trade it. And we know that IBIT would be a great way to go about doing that. All right, what else do we want to talk about? What are some of the practices that in 2025 you want to make sure that are a regular part of your day? Well, one of the things that we've been doing now for about, I guess, 5 months, 4 or 5 months, I can't remember how long, is we have a saying in the Sector Secrets Mastery: every entry, every exit, every day. So you all will know, obviously I'll send the alert out, that at the end of the day, I'll send my current tally of open trades, all the prices from which I've entered, right? Not the lowest. All the prices at which I've exited, not the highest, right? And everyone can see, oh, Rog lost there. That was a losing alert. That was a winner. And how much per contract? Because here's the other part of it. There's always this temptation to, get out there on social media and hear about someone who made, I don't know, a metric, whatever, of profits. I don't care if it's prop trading or if it's trading their own money. Everyone's fascinated by turning a little bit of money into a lot of money. Or the thing that I've been seeing so much now is turning somebody's money into a lot of money. And all that's great. And I'm sure some people do. But in the case of, say, the 2008 financial crisis, does anyone think that there were a lot of folks who tried to put on similar trades to the folks who were highlighted in that movie, in that book? Great movie, great book. The worst thing to ever happen to trading. It celebrated the exact worst thing. It celebrated putting on these bravado trades with monster risk, sitting through monster drawdowns. And then, obviously, yes, some of these people made billions. You might say, Rog, isn't that the point? No, the point is that same road was littered with people who couldn't lock out their investors from redemptions, littered with people who could not continue to throw money into that losing trade. People seem to think those are the only folks who did it. Oh, gosh, no. Oh, gosh, no. The roads are littered with folks who couldn't hang on to that trade. And that really should have been the book that was written, right? Not the celebration of, oh, look, they picked the top of the housing market. They did not pick the top. They picked maybe the second or third peak down and had to wait through the top, and then they made a lot of money. But we celebrate that. So what's happened in the wake of that? Folks bet big. They're picking tops because they have Michael Burry syndrome. Hey, no knock on the guy. Clearly he does fine, but let's remember the path they took. How many folks would have had the stomach to sit through what that guy did? Right? Not money, and have the money to sit through what that guy did. So remember, when you're looking at things, that's what I want to do. Remember, there's always two sides to that story. And so what's happened now is folks want to, always predict, Bitcoin's going to 250 or whatever nonsense I've heard last. As soon as it crossed 100, where's it going? Yeah, maybe it's going to 250, but maybe it's going to 75 first, and then it's going to 250. Right? Whatever that number is, it's for trading. Keep this in mind. It's the journey to the target. It's not the target. It's the journey to the target. And that journey is untenable. That means the risk is not within parameters that would put our capital at risk. Love your money a little bit. Protect it, right? That's what we do in trading. We manage risk. We protect our capital. Because once your capital is gone, you're out of business. So think about the journey to the target in 2025. Think about what you're trading. Are you following what the narrative is? Are you listening to traders who never have losses? Yeah, there's a word for that. And I'll be nice and not say it. But yeah, again, I'll need my hip boots. So remember, if you're talking to someone who's talking about all their big wins, ask them really quickly because they should know this. If these are your three biggest wins, what were your three biggest losses? And I'll promise you this. Most of them, I will say 9 out of 10, will have losses in size that's larger than their biggest wins. And that's where traders get into trouble. So be careful, right? 2025 is a whole new year to do it right. If you're a smaller account, you're just going to trade fewer contracts. And a different style, right? Not something magical. Smaller accounts just trade less, so the same thing bigger accounts would trade, right? That's it. I just demystified those of you starting with smaller accounts. If a larger account like myself or even other members are trading 20 contracts, you might be trading 2. That's okay. Growth is organic. Win after win grows the account, grows the confidence, And then that's organically how you trade larger and larger. I know it's not what people want to hear. I want to hear about the person who turned 500,000 into 500,000, $500 into $500,000, right? Okay, right? But in the real world, what we're going to do is we're going to practice sound risk management and play for the risk management of the trade and let the rewards take care of themselves by doing everything else right. I know, not the sexiest message, right? But I'll be here all through the year, and I'll be here in 2026 telling you the same darn thing. And when folks are finally tired of chasing after pipe dreams and set it, forget it, and trading is so easy, and I hang out at the picnic all day, well, I'll still be here, and I'll be happy and willing to help you. All right, gang, have a great one. Happy, healthy, prosperous new year for you and yours. And I'm looking forward to another year of getting our process down and taking profits from these markets. Be good to each other. I'll talk with you soon.